This is The Wealth Puzzle with Michael Mansfield from the Lynn Group. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Michael provides his clients and prospects with the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful solutions to put you on the path to achieving your retirement goals. And now, here is The Wealth Puzzle with Michael Mansfield.
Hi, everybody, and welcome back to The Wealth Puzzle. It is myself, Owen, today on the podcast. We've got a couple of really interesting things to talk about. We got some continuation of earnings season, as well as some real interesting market headlines and geopolitical updates to tackle today. So we will do our best to do all those things. The goal is to make this video relatively short for you guys, short and straightforward. Texas is super hot. Over the weekend, it seems like the thermostat was pushed up even further. We're going to be experiencing the first 100-degree weather for the year. That is always super, super exciting. I say that incredibly sarcastically. So if you're in Texas, any of our Texas clients out here, stay cool. Enjoy the AC. Go to the pool. Go to the lake. Stay out of the heat. Okay, let's talk about the S&P. So at the end of last week, we had an interesting little sell-off, didn't we? The market was at all-time highs, really, above that of 7,500. Again, Mike talked about it in his video that analyst expectation is around 8,000 for the end of the year. And so in all reality, the market's doing really well. The economy is doing really well. And so these are all really good things. And then, of course, on Friday, there was a bit of a sell-off, a lot of profit taking and things of that sort. Let me throw this up here. You can see that being illustrated here with this little bit of sell-off, this little downtrend here. Now, a lot of that was actually driven by a mass sell-off in semiconductors. And so let me move over to this one instead. So if you look right here on Friday, they call it the semiconductor index. So it's a good way to look at aggregate data as a total. It fell by 10% on Friday. And so it made a really interesting point that I really wanted to talk about, and that is momentum trading. AI, all the high-flying semiconductor stocks, they were profiting really well for the last, call it 3 or 4 or 5, 6 months, even a year. It's been AI. But momentum can kind of be the bane of your existence, right? In one hand, there's a lot of money to be made, really great rates of return, and on the other hand, what's the word here? The shoe can fall at any moment. I'm probably butchering that, meaning if one thing goes, well, then so does everything else. And so that's exactly what we had play out. You have a lot of people jump on board the AI semiconductor trade, and then as soon as all of the call them buyers became owners, and then we got just a little bit of uneasy news around semiconductors and AI in general. Well, then now all of those owners, all of those individuals who bought in, well, now they all want to get out, and so now you have a influx of just individuals trying to leave that specific sector, and you have a giant sell-off. Now, the interesting part about this all is they didn't just sell to cash, right? There's not just a mass exodus from the market in general. Really, what's happening is you have a lot of investors going from a high beta sector like semiconductors, AI, tech, and things like that to, well, now they're transitioning. The playbook is changing. We're now looking at value stocks that aren't going to move a lot, stocks that have, historically speaking, paid a dividend, have strong balance sheets. They're not shaking things up. They're sticking to what they do really well. So Johnson & Johnson, Home Depot, companies like that would be a good example of a value play. So you've got huge flows out of semis and huge flows into value. And it played out really interestingly over the weekend. And so it's just something to be aware of, especially when you're doing your own trading, you're picking your own stocks, that yes, chasing the next best thing can be good, but at any moment, well, it can be pulled out from underneath you. And if you're riding that train with everybody else, it's just a matter of how fast can you get out and how much profit can you take. So something to be aware of, something to pay attention to when you are buying and selling stocks. But all in all, there's a bit of a rebound occurring this morning. Some of those losses were a bit exaggerative, and so now you have some people buying back in and trying to recoup any of those losses they might have experienced. So it'll be interesting to see how those play out. But for the most part, nothing to be overtly cautious about, especially if you go back to, let's look at this one real fast. Especially if you go back to the S&P, even with a 10% sell-off in a single specific sector, the S&P is still sitting just under 10% year to date. So all things considered, we're in a really strong place. The economy is doing well. The market is doing really well as a whole. Okay, so that is what I wanted to talk about in terms of markets. Let's talk about the Middle East, right? Oil is back up to, well, $80 as of the time I'm making this video, but over the weekend it shot up to above $90 a barrel. A lot of that driven by this new strikes that occurred from the U.S. Now, most of this is around the idea that Iran is not ready to make a deal. They won't They won't give up any room on the idea of enriched uranium. They want the ability to at least possibly create a nuclear bomb someday in the future, and the U.S. is just not going to have it. And so they're at a standstill. There are some other small pieces of this. You might see in the headlines, right, around the idea of who gets paid for the Strait of Hormuz. Don't just ignore that. It's just noise. No one's getting paid to own or control the Strait of Hormuz. It's going to continue to act as sort of a global exit and entry point for the world to oil and gas. Even the Trump administration did come back on any rumors of trying to control or receive payments like receive payments in the Strait of Hormuz. So things like that are just adding to the fire, but majority of the conflict arises around negotiations. Now, more strikes happened at the beginning of the week, or beginning of the weekend, and then as we've gotten closer to Monday here today, Iran has recently said, hey, look, we're open to some negotiations if there is anything on the table. And so I think a lot of that is why the oil futures market is sort of pricing oil again around $80 a barrel. But if you go back, I don't know, at the beginning of the Iranian conflict, even with negotiations being on the table, oil was still sitting well above $100 a barrel. And so it's quite interesting that the oil market, the futures market, sees this as sort of negligible. They feel that there is an end in sight and that it isn't going to have a long-term impact on the price of oil as a whole. And that's just what the oil futures market is telling us. That isn't necessarily coming strictly or directly from the administration. But, it's something to consider. I think these are all really valuable pieces to sort of pick and splice your way through what is actually occurring out there right now. So a lot there. It's been a whipsaw, a very volatile market, not just in oil, but across the economy as well. But there is a silver lining, right? And that silver lining is earnings season. So I'm going to move over to this one right here. Earnings season is upon us. Mike made a video about earnings and that they were approaching. The good news is banks did exceptionally well. In fact, I made this super impressive, mainly unimpressive chart showing earnings. Look at that. You could probably, your child in 5th grade could probably make this chart, but if Mike asks, it was a really cool chart, okay? But what I'm showing here is net income in billions in blue and the estimated net incomes before earnings posted. So across the board, all of the big banks, JP Morgan, Bank of America, Citigroup, and even Goldman, even though it's not on here, beat their expectation. But more importantly, JP Morgan right here killed it. I mean, they had a record quarter. And so that was a really, really good thing for the market. And I think added to the strength even with the sell-off. And so you had very conflicting things. You had financials doing really well, again, holding up everything, while you had the semis pulling back. And so you had two different areas of the market performing well and performing poorly. But why is this important? Well, just because banks did well doesn't mean necessarily everybody else is going to do well. Meaning, what's coming down the pike? Well, we now are entering corporate earnings season. So we're going to start seeing things like Alphabet, Google, Amazon, like all of those big companies are going to be posting their quarterly earnings. And so the conversation is now, look, we had a really good earnings report from banks. What is that going to look like from a corporation standpoint, right? Because if you get both banks and corporations beating their earnings, making a lot of money, well, the system keeps on churning, right? But if you get one that's bad, meaning, hey, banks did really well, but corporations did poorly, well, now you have an offsetting factor there. And now banks going forward, well, there won't be as many deals being written, right? There won't be as much debt or things being pushed into the economy to sort of prop up those earnings. And so you could almost make the assumption that corporate earnings season will be a indicator of what we could see down the future with other systematic, or I should say other market sectors. So the goal is that, the goal is that, yes, we got good banks, but we'll get really good corporate earnings. The problem is expectations are really high. And that's what I'm showing you right here. So this red number or red bar chart shows the what is the word I'm looking for? The expectation, whereas the black bar shows actual. And so, yes, we had a really good Q1, but in Q2, you can see that giant leap, a huge leap into what the S&P is sort of projecting across the board. And so we've set ourselves up for potential failure or a really, really strong indicator of growth. And so it'll be really interesting to see how these things play out. I wanted to show you guys so you could at least be aware of what's coming. Most of this stuff doesn't really kick off until the end of the week. You'll get 3M tomorrow, Tuesday the 21st, but like the big ones, let's see here. Yeah, the big ones, Intel, maybe it's Wednesday. Yeah, so Wednesday we get Alphabet and Tesla. So that'll be really, really awesome. IBM as well on Wednesday. Let's see about Friday. Yeah, American Express, that'll be a good one. Verizon, some of these other companies. So it's sort of scattered out across, call it Wednesday through Friday. We'll be getting some pretty good earnings calls. So that'll obviously have a lot of called tailwinds into where the market decides to go. Good news is going to push the markets up, and bad news is going to obviously try and push the markets down. With that being said, the markets have been incredibly resilient. We've been able to weather a lot of bad news. And so I think that is the overall analyst forward guidance, forward projection is that the markets are going to weather some bad news here and there. So that's all I have for you today. I hope you guys are doing well. Mike will probably be back on the pod next week. And with that, I will send you guys away. Have a great week.